welcome back to my channel. My name is Brittney and welcome to Real Estate Brittney. On this channel, we talk about real estate, we talk about credit, we talk about lending options, all things related to real estate, credit repair, and loan servicing is what I like to bring to this channel. So please go ahead and subscribe. I'd love to have you a part of the channel. A little bit about me, I am a realtor here in Michigan. So if you have any questions regarding the value of your property, if you're looking to sell, if you have any questions in regard to looking into investment properties, or if you are looking at purchasing a home, whether you be a first-time home buyer or an experienced home buyer, I am more than happy to assist you with resources and guide you through that process. So be sure to check out some of the other links below in my description box as well. Today, I'm going to answer a question that I got so frequently during loan servicing. So I have been in the lending banking field for years, and doing mortgage servicing, I got a repeated question, and that question was, why did my fixed rate mortgage increase? And almost all of the time that question was asked, the answer that was provided was your escrow analysis. We had an escrow analysis and there is a shortage on your account. And I would get a lot of questions like, well, I'm looking at my escrow balance, and my escrow balance is X amount of dollars. So how can I have a shortage? And all of that information, all of those questions and those type of conversations is what I had. And so I'm going to be doing a couple other videos breaking down escrow even further, but I wanted to come on here and give you all a general idea of how escrow works and why it does impact your payment. And I'm also going to let you know at the end of this video what you can do if you no longer want to deal with escrow, and who has the option to look into the option that I'm going to provide. So stick around. First thing that I want to go over is escrow. Okay, what is escrow? Escrow is pretty much like a savings account. Think of it as a piggy bank for your taxes and insurance. Out of that account, your mortgagee sends payments to your homeowner's insurance and also to your taxes. Now, this is something that is good for both parties typically, because you don't have to worry about paying out the policy. You don't have to worry about making sure that you stay on top of your taxes. As long as you're paying your mortgage, your escrow, part of your payments are going to go to your escrow account. So you can just sit back and relax knowing that, okay, hey, my insurance is being paid for, my taxes are being paid for. And then there is an analysis that's typically run once a year to give you an idea of if there's a shortage and if there's an overage or a surplus. Just letting you know where you're at in your escrow account, if money needs to be placed back in your account, or if you're going to be receiving a refund check or credit, depending on the amount of a surplus in your account. If it's a smaller amount, I believe like around $30 or less, then it can be credited to your account with some mortgage companies. But other than that, if there's a surplus, typically it's sent back in a refund check to you. So it's good for you in that aspect. It's also good for your mortgagee because it's another added protection for them. They're making sure that your insurance is paid, they're protecting their investment, and they're also making sure that your taxes are paid. They don't want any liens against the property. Again, they want to protect their investment. So with that being said, a lot of times you go ahead and you're paying your mortgage, the mortgage is the same amount, and then you receive a statement and your mortgage has increased. And you're like, what happened? So normally you would have received before that statement an escrow disclosure statement, because your mortgage company will need to notify you of any increases in your payment. And that mortgage disclosure statement will show what has been paid to your insurance and also what has been paid to your taxes. It also gives you a breakdown of projections, and it gives you a breakdown, a lot of times, breakdown of how much your insurance increased from the last year's payment, and also how much your taxes increased from the last year's payment. Typically, what I've seen most of the time during the calls that I would take, and I would take about 50 to 60 calls a day incoming, and then I would make about 50 to 60 calls a day outgoing. So I talked to a lot of people throughout that month. And what I would notice is homeowners insurance increasing, especially in areas where there is natural disasters, areas where there are wildfires. My heart goes out to all of you that have experienced any natural disasters. And I've even seen some insurance companies drop their coverage options, saying, they're no longer going to cover that property. And so in the event that your homeowner's insurance increases or your taxes increases, what happens is you typically have like a shortage. Now, the way that you can have a shortage and also have a positive balance in your escrow account is, and I'm going to do a more in-depth video on this, but just to give you a brief overview, is because your balance is typically 2 or 3 months of taxes and insurance in that savings or piggy bank account. Once you drop below that threshold, that minimum required balance, anything below that is going to be considered your shortage. And so that's the money that's going to need to be put back into your escrow account. So let's say that that money isn't put back immediately. On the disclosure statement, you're typically given like 2 different options, either to pay the shortage off with a one-time payment, or they take the shortage and they divide it by 12 months. So if your shortage is $1,000, they'll take that, they'll divide it by 12, and then each month your payment will go up $100. Also can request with a lot of different mortgage companies for another escrow analysis to be run after you've paid into your escrow account to see where that's going to put your payment. Sometimes it brings your payment lower, sometimes it makes your payment higher, depending on what the status of your escrow account is. Have they recently paid out your homeowner's insurance? Have they recently paid out taxes? Should you just wait until the natural escrow analysis the following year? Or would you be better off requesting an analysis at this moment to save more money? Those are some of the things that you want to look at. Those are some questions that you may want to ask to see if the mortgage servicer that you're speaking with on the phone can give you an estimate. A lot of times they can over the phone just crunch some estimated numbers and give you that information so that you can make an informed decision. I do want to say this too, FHA excluded. There are options with a lot of different mortgage servicers too to not be escrowed. So if you are wanting to have a more consistent payment and not worry about your mortgage payment increasing or, fluctuating when the escrow analysis is run each year, then you can look into that. See if you are able to no longer have your account escrowed. That means that you're going to be responsible for paying your homeowner's insurance and paying your taxes separately. There may be an application process that you have to go through. There may be a review that the mortgage company will do on your loan before they grant that ability for you to no longer be escrowed. But that is something else that you can ask for. I know FHA, you don't have that option to look into not being escrowed. So I just wanted to put that out there. I really hope that this helped. I didn't want the video to be too long, but if you have any questions in regard to escrow, your mortgage payments, or anything like that, feel free to leave them down below. I'll do my best to help. I do want to thank you all for watching, and I'll talk to you on the next video. Bye.